The year is coming to an end soon. The calendar days are flying by, and soon companies will begin to ready their annual reports, and in 3 months' time they will be on the roadshow presenting these to institutional investors. In the meantime, everyone can actually access the latest 9 months results from companies on their websites, but even better by going to Seat11a and see results on the 9 months from companies such as the German LEG Immobilen, the German property company that has been working with Seat11a for quite some time. Without any more delays, let us just take a look at what Seat11a can offer and how LEG Immobilen presents to all investors through this portal.
Hello, thank you for watching the video. I'm Frank Kopfinger, Head of Investor Relations and Strategy at LEG. With our 9 months results, we provided the markets with a couple of highlights, which I'm going to address in this short video. First, we are fully on track for our 2024 guidance of 190 to 210 million euros. Second, we expect valuations to stabilize, and we provide an outlook for H2 valuations of 0 to positive 0.5%. Third, at the same time, we made progress on our capital recycling strategy, and we made further progress on our disposals. Year to date, we sold roughly 3,400 units for about 330 million euros. Fourth, on the back of this stabilization and valuations, we also announced the acquisition of 63% in Brack Capital Partners. And with this step, we add another 9,000 units, or around 5% to our current portfolio. Fifth, our financing structure remains very robust. Our average cash interest remained low at 1.6%, at an average maturity of almost 6 years. And sixth, we provide markets also with our 2025 guidance, which offers another growth of 7.5%. And let me walk you now through those highlights. After 9 months, we achieved an AFFO of 152 million euros, and we are well on track to reach our target of 190 to 210 million. This offers investors an increase of 10% over the 2023 level, taking the midpoint into account. Our operational drivers continue to reflect the momentum we see in the market, i.e. rents increased by 3.2%, and we could further slightly reduce the vacancy to 2.4%. Effectively, we are fully rent out. Our rent increase only reflects increases within our free finance part of the portfolio. This represents roughly 80% of our portfolio, whereas we will see rent increases for the subsidized part of the portfolio only in 2026. So the 3.2% growth rate on the portfolio level therefore translates into a growth rate for the free finance part of very strong 3.8%. On the valuation, we see light at the end of the tunnel. We expect valuation to further stabilize from here. We do a revaluation of our portfolio on a semi-annual basis. And for the second half of 2024, we provide an indication, and we expect valuations to be flat or see even a slight uptick from here. And to be precise, we expect valuations to develop between 0% and plus 0.5%. And just as a reminder, from the valuation peak in H1 2022, until H1 2024, we brought down valuations in total by almost 17% for the entire portfolio. The value per square meter of our total portfolio amounts now to roughly 1,600 euros, which is significantly below the replacement level. The gross yield of our total portfolio amounts now to nearly 5%, and the net initial yield stands at around 4%. With this, we feel quite comfortable with regards to the yield being already offered by our portfolio. And with this, we are also comfortable when it comes to our valuation outlook. Then we also made further progress on our disposals. Year to date, we sold more than 330 million euros or 3,400 units respectively. However, until end of September, only 87 million euros have been transferred and are reflected with our 9 months results. This means that the remaining more than 240 million euros are going to be transferred until the end of the year, or even only in early 2025, when we receive the cash accordingly. All our disposals have been done at or even slightly above book value, as we are not willing to pass on shareholder value to the buyers. And on a net basis, i.e. after the redemption of the underlying debt, paying taxes and transaction fees, the 330 million cross proceeds will translate into net proceeds of roughly 205 million euros. This will help us to bring down our LTV, and our medium-term LTV target of 45% remains unchanged. And with this, let me come to Bragg Capital Partners, or BCP. Early November, we announced the acquisition of 63% of BCP. We already acquired a stake of 36% in 2021 and 2022. BCP holds about 9,100 residential units, and the portfolio represents a perfect fit to our existing locations. There's an overlap of more than 90% with our locations, and we can open up a new attractive hub with Leipzig. So to put things into perspective, BCP makes up for around 5% of our existing asset base. We would therefore regard it as an bolt-on acquisition, and it allows us to finish the entry we started already a couple of years ago. We buy the 63% for a total of 219 million euros, and this represents a major discount of 48% against the last published NTA of the company. So far, the 35% stake which we already have was accounting-wise only treated as a share participation, and the company did not pay dividends to preserve cash. So from 2025, we will fully consolidate BCP. And we will certainly realize synergies, especially on the financing, operational, and admin side. We will, however, see no effect on an AFFO level in 2025. This is driven by the fact that we will see an increase in the CapEx spending towards our LEG level, and this acts as a headwind towards the AFFO impact. We therefore expect additional AFFO contributions only from 2026 onwards, and we expect additional AFFO contributions of more than 5 million euros by 2027. Our ambition overall with BCP is to shift the profitability level towards the LEG AFFO margin over time. On an LTV basis, we expect no material effect, and given our low entry price, we expect even a positive effect on the NTA. And with this, I come to our financial profile. Our financing remains rock solid. We continue to benefit of an attractive financing structure. In late August, we issued a 500 million euro convertible bond at 1% cash coupon. This allows us to further keep our overall cash financing costs at very low level of 1.6% at an average maturity of almost 6 years. We have no 2024 debt maturities on the agenda, and the maturity of the remaining 2025 maturities of 801 million euros is covered by cash and incoming cash from disposals, even after taking the price for the BCP acquisition into account. This puts us, therefore, in a very comfortable position to opportunistically refinance or repay some of the 2025 debt. Also, when it comes to debt KPIs, our ICR ratios stand strong in sector context at 4.1 times. And then finally, let me walk you through our 2025 guidance. For 2025, we expect the AFFO to further grow to a range of 205 to 225 million euros. This represents another increase of 7.5% if you simply take the midpoint of the 2024 as well as the 2025 range into account. As a reminder, this comes on top of the 10% AFFO growth, which we already aim for 2024. Key driver for next year are another strong rental growth, where we expect a growth of 3.4 to 3.6%. And this is another 20 basis points increase and reflects the underlying market dynamics on the back of a massive undersupply in the market, and while the demand remains very strong. We are also going to further grow investments by at least another euro per square meter, i.e. we increase it to more than 35 euro per square meter. And with this, I come to the end of my video. I hope I gave you a good overview of our 9 months 2024 results. You'll certainly find the entire reporting set on our webpage within the IR section. And should you have any questions, then please do not hesitate and reach out to me or the entire IR team. Thank you and goodbye.
Disclaimer. As described in the legal section on our website, Seat11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. Seat11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By